Hey, welcome Realtor Partners. I thought I'd send out a quick video because it occurred to me the short-term fixed rate ARMs, so hybrid ARMs like the 5/1, 7/1, those have come down finally, and that might be a great tool to help buyers get into homes affording more, making the payments easier. So I thought I'd just do a quick review, and hopefully this will be another tool in your toolbox. So FHA versus conventional, which is better for first-time buyers, and should they be doing an ARM right now? So I'll just go through quickly what a first-time buyer is, the pros and cons of FHA versus conventional, and then are ARMs better with some payment comparisons. So what is a first-time buyer? First-time buyer from banking's kind of definition is that, and this is mostly under Fannie, Freddie, and FHA, we'd be talking about this. But keep in mind that FHA does not have any restrictions on the interest rate for first-time buyers. So a first-time buyer and a previous home buyer, repeat buyer, they get the same rate under FHA. So it's really, the first-time buyer benefits are really interest rate-wise under Fannie and Freddie. So they say that you have to have no ownership in the last 3 years. And that means being on title, like if someone co-signed or is on title with their parents or whatever, that is home ownership. So being on title or being on the loan in the last 3 years would mean that you're ineligible as a first-time buyer. You are not a first-time buyer if you've been on title or been on a loan. Now, the exception to that rule is if you've been divorced and you are now starting out on your own again, then the 3-year rule doesn't apply. So that's nice. No minimum time for divorcing people. Okay, so the benefits for first-time buyers are you get down payment assistance from state and local government agencies, religious organizations, and you get a lower interest rate under Fannie and Freddie. But FHA and VA do not kind of segregate that. They don't punish you for having owned a home before. So FHA versus conventional. So on the left-hand side, I've got attributes of the loan program, then FHA column and conventional in case you're listening and not hearing. So, listening and not seeing this. So FHA, so assumability. Can someone take over the loan? I get a lot of questions about this. Can I just take over that low 3% rate? So FHA is an officially assumable loan, and you have to apply and be approved just like a regular loan, but you could take over a very low interest rate from the past instead of having today's higher interest rates. Conventional or Fannie Mae and Freddie Mac loans are not assumable. So you can try, but they are not assumable. So the likelihood of the lender saying yes is like slim to none. So if you are looking for an assumable loan, or if you're showing property to your clients, I would always look up to see what kind of loan the seller has and what the loan balance is or what loan amount they took out, because maybe they bought, let's say in 2021 where rates were still low. In the last 4 years, they have built equity, but maybe not so much equity that it's impossible to bring that cash to the closing table and take over their loan. So number two, no appraisal or qualifying on a refi. So FHA allows you to refinance with no appraisal and no requalifying or limited requalifying. Fannie Mae does not have that option. So if a client thinks that they're going to buy a home now and refinance in a year from now, sometimes that's a big deal because they might anticipate a job change or something like that. So that's a really big pull on the FHA side. So choice of whether to do impounds. So impounds are where your taxes and insurance are included in the mortgage payment. So on the FHA column, we've got no, even if you put 50% down, the loan requires that taxes and insurance and the mortgage insurance be rolled into the loan, as they call it impounds or escrow account. The other thing is you pay PMI on an FHA loan, even if you have 50% down. No matter how much down payment, you have to pay that mortgage insurance to FHA and wait a certain amount of years before it's eliminated. Whereas conventional loans, first of all, you can choose whether to have impounds or not. State of California has a law that says if you put 10% or more down, a lender cannot force impounds or escrow account. So your taxes and insurance can be paid separately by you when taxes come due, when your insurance renews. So just keep that in mind. For some people, budgeting wise, they really want to control their own tax payments. And so PMI options. So with FHA, there are two types of mortgage insurance, and we don't actually call it PMI for FHA. It's MMI and upfront MI. So on FHA loans, there's a one-time upfront mortgage insurance premium. It's 1.75% of the loan amount, not the price, but the loan amount. So that 1.75% can be financed or paid in cash. 99% of people just finance it. And then there's somewhere around 0.5% mortgage insurance that's paid monthly. You cannot eliminate that. Versus with conventional loans and traditional private mortgage insurance, or PMI, there are several ways to do PMI. You can have it monthly. You can have wrapped into the rate. You can have it as a one-time fee added to the loan. You can even do a split difference thing. So there's lots of tools to make home ownership more affordable for people. And then I indicated that on a 10% down, or FHA could be 3.5% down, but your mortgage insurance is much lower per month with a conventional loan than with FHA. And so, so you have three different types of choices with that. So that's a summary of the pros and cons. One of the biggest pros is the interest rate category, and I'm going to go into that for just a second. But remember, FHA doesn't charge more if you're not a first-time buyer. So today, 5.875 is the rate. That is the rate for everyone. Versus with Fannie and Freddie, today's rate was 6.375 for first-time buyers. But if you're not a first-time buyer, it was much higher, more like 6.75. So you're paying a premium if you're not a first-time buyer, or if you are a first-time buyer, you're getting a really big discount, usually about 0.5% on the interest rate. So on the next rate comparison, payment comparison, and this is the end of the presentation, I wanted to just point out where we can make this more affordable for our buyers. So number one, the first column here is a conforming conventional Fannie Freddie 30-year fixed first-time buyer, so 6.375. And so our mortgage payment, P&I, and actually this includes taxes and insurance. So sorry, this is on $800,000 purchase price with 5% down, 5% across the board. So your payment would be $47.41. The mortgage insurance is $183. If we slide all the way to the right, you can see that on the same loan program with FHA, the mortgage insurance is $440 per month. Okay, so that means that in column one on a 30-year fix, we're at $49.25 per month. If we slide over to a conventional 7-year fixed that rolls over to a 6-month adjustable SOFR ARM, after 7 years, it's going to roll over to an adjustable. That payment drops $300 a month down to $46.18. So if you've got a buyer that's already stretching, this would help them a lot, right? And then my third column, I wanted to compare an ARM to an ARM. So a conventional ARM, 7-1 ARM, to a 5-1 ARM. So that means a 5-year fixed that turns into a 1-year adjustable based on the Treasury. So slightly different indices, but the best programs I could find for both. So that gave me, instead of 5.75 on the 7-year fixed, I've got 5.244 today as of, I think it says, 11:20 in the morning. So that gives me 5.244 in interest rate, a mortgage payment even lower of $42.67. So I'm saving another $160 a month, but my mortgage insurance is like $250, $260 higher. So my all-in number with the FHA 5-year fixed ARM is $47.07. So unless they want all the bells and whistles of FHA, ding, 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 the Fannie Mae option right here in the middle of the convention 7-year ARM gives you a little more time before the rate changes, is at $46.18. So depending on what your buyer is needing and what they qualify for, one of the things I left out was that FHA, I can have credit score all the way down to 580 and still get them this sweet deal. If they are below 700 on Fannie Mae's options here, the rate will be about 1/4 to 0.5% higher. So if you have a low credit score person, they are definitely going the FHA way to save the most money on their mortgage. So I hope this was helpful comparing FHA to Fannie Mae and Freddie Mac and what the differences are. And most importantly right now, save those buyers some money on their mortgage payment or help them stretch into more home by lowering that rate by going a 5 or 7 year fixed. I hope that's helpful. Have a great day. Reach out to me if I can do anything to help.